investors continue to leverage on liquidity, reaping short-term gains in the T-bills market. Meanwhile, local, corporate and municipal bonds are still enmeshed in relative illiquidity. The sovereign yield curve continues to respond to recent shocks within the macroeconomic space. We talk T-bills and bonds with Robert Omotunde, investment researcher at Afrinvest. Robert, it's great to have you on the show with us. First of all, let's first of all look at what the market is doing, because liquidity levels have dropped to, I hear, around 100 billion levels, because the CBN was aggressively mopping up that liquidity. There's a few Omo auctions, I believe. Tell us about that.
Thank you for having me once again. What we've been seeing recently in the market as regards liquidity is what we can describe as cautious trading of investors. And we also saw that in the recent past, we've seen, like you mentioned, the level of liquidity which has been hovering between 100 to 200 billion, and the CBN is not leaving any stone unturned. They have continually come up with different Omo auctions, at different times, majorly to manage monetary, policy objectives. But generally, what we can say for the market is that investors are very cautious. Okay, macroeconomic headwinds are still there, and there are so many things that investors are not so clear about, and so they're just taking their time.
Okay. Now, I'd like to get your thoughts. Obviously, we're talking about risk management quite a lot. We, we did that yesterday. Today, we're continuing on that. We know that, the fixed income instruments are largely risk-free. I mean, that's something that, allows them to be more attractive to investors than the equity space. There are a few risks that exist in, in this space still, credit, interest rate risk, currency, inflation, reinvestment risk, liquidity risk. When you look at the pricing of some of those instruments right now, and then you compare them to the risk, what are your thoughts in the way they the balancing?
What we've it's hypothetical to think that fixed income investment are risk-free. Indeed, they are not absolutely free of risk, like you mentioned. A number of risks are involved, and if you look at what has played out in the market pre-election and what we saw post-election across the fixed income instrument, we saw investors playing more, at the shorter end of the curve, taking position in T-bills. But for bonds and at different levels, whether for corporates or even Eurobond, during the period of the election and even post-election, we saw a number of risk crystallizing. And what we've been able to analyze is that if you check some of the Eurobond, trading on the floor of the London Stock Exchange before the election, we saw from the yield of 5, 6, 7%, we saw what those bonds were trading at as high. Some traded as high as 15%. And of course, because foreign investors, we always try to factor all of this risk, into their pricing. But because at the local level, of course, we saw higher yields at this time that I mentioned, but again, maybe they are not as appropriately priced as those markets will price them. But what we are saying now is more or less a normalization of the situation, okay? Because if you look at, you check along the yield curve, what we're seeing now is an average yield for the bond instrument at an average of about 13.9%. Even though we believe that this still presents opportunities, the risks are still there. Some of the risks have been, tempered, but issues about credit risk and some other risk like reinvestment risk and FS risk for foreign investors who are wary of coming into our market now because of a possible near-term devaluation as soon as the policy of the new government becomes,
I can imagine that is impacting quite a lot on the corporate Eurobond market. I mean, generally, local, corporate bonds and municipal bonds. We know that that's not a very liquid space. Just this last week, or I think it was early this week, we heard about Stanbic IBTC, of course, listing on the FMDQ OTC platform there. We know that, before that, I believe it was UBA that did the same thing. Still, there's a lot more interest in federal government bonds than a lot of these corporate bonds. What do you think needs to be done to stimulate interest in corporate bonds? And why do you think people are not as excited about corporate bonds as they are perhaps about federal government bonds?
Yes, as we speak, we noted in our earlier report that they are still immersed in a lot of illiquidity, and given that most of the corporate bonds trade on OTC platforms, and that does not present an adequate market pricing of some of these bonds, and that's the move that FMDQ is taking to ensure that a lot of these corporate bonds and possibly state bonds can trade on the main board of the FMDQ platform, such as we have for the FGM bond, apart from the lesser risk that the sovereign bonds carry. The fact that you can really trade them, particularly on FMDQ platform, and when you want to get out for some of them, it's not all the sovereign bonds that are also very liquid, but for those of them, the benchmark bonds that are very, very liquid, when you want to get out, you can easily get out. So what can be done to really stimulate interest in the municipal as well as corporate bonds is to create the liquidity that is required, to be able to trade these bonds.
Let's move back to that T-bill space. You mentioned here, in your report, short-term investors leveraging on the liquidity. Yesterday's session, I believe that there was a lot more demand in the medium to long end of the curve. Are things changing, or is this just maybe just something that happened in one day? And also, I guess you could also tell us your investment strategy for the second half of the year. Obviously, we're in June. In a few weeks, H1 is over. Okay,
right. The periods that characterize, the election periods, basically, what we saw investors doing was more of, taking position within the shorter end, like I mentioned earlier. And this is due to the fact that they just want to moderate the risk. The shorter end provides some form of liquidity that allows them, to be able to make short-term gains. And what we are seeing now is a possible change in dynamics, because the coast is kind of becoming clearer. Okay, the Senate has been inaugurated, and very soon we would expect that the cabinet list will be out. And so we are saying that investors who want to leverage on, who want to ride on the yield curve for fixed income investment, we need to look at this time as a possible time, to take position, because as soon as the market, rebounds, we'll begin to see a lot of demand.
Thank you so much for joining us, Robert. Robert Omotunde is investment researcher at Afrinvest. Now,